Hi traders, Namaste. In one of my recent videos which I had posted, Shubhra Roy had asked a question, this one, wherein he asked me that can you make a video on value stocks that should be bought now? So Shubhra, this video that I'm going to make today is dedicated to you and your question. But value stocks essentially is a company concept wherein fundamental plays a role. So let's take a look in this video how we can try and pick value stocks using technical analysis. All right, so as I was telling you that value is essentially a concept from the subject of fundamental analysis, and technical analysis focuses only on price. So is it possible to use price as a factor and find value in that company? Well, to some extent, yes. In fact, it gives me a lot of pleasure to share with you that this particular aspect of bottom fishing using price is something that I am fascinated with, and I've tried various ways, and I'm going to share one way with you in this particular attempt. What you have in front of your screen over here is a ratio chart. Now, when you want to seek a value stock, a stock which is valuation wise attractive, it is very important that you first take a look at the overall market. So first we will take a look at the Nifty, whether Nifty is or Nifty's value is attractive or not. And if the market's value seems to be attractive, then only we will take a look at stocks. Now, how do we together value the Nifty, and how do we figure out that the valuation of the Nifty is attractive? And so relativity comes into play. So what I've done in this particular chart in front of you is I've tried to value Nifty vis-a-vis gold, and this is called a comparative chart. In my YouTube channel there is a playlist on TradingView tutorials. If you're interested, there is a video which talks about comparative charts. You can take a look at that. I'll share the link in the description box. But I can show you right now over here. What you have to do is just type Nifty, select it, divided by gold, and you can select the gold near month futures from MCX or the dollar gold. In this case, I've taken the new month future. And whenever you do this, please remember to multiply it with 100. It will normalize the chart. So over here, what we are looking at is the spread chart or the ratio chart between Nifty and gold, which means that if this chart is falling, the numerator is falling in relation to the denominator, which means that when this particular chart is falling, you should sell Nifty and buy gold, and vice versa. When it's rising, when it's in an uptrend, you should look to buy Nifty and sell gold. This is the basic logic of a ratio chart. Now our attempt over here is to figure out that when the market corrects, and in this case when the market corrects, this chart will correct, that is Nifty will correct. In these downtrends, when does it get really attractive? Say for example, this is the March 2020 lows. Can we have something over here which tells us that in relation to gold, Nifty is attractive, relatively attractive? So one of my attempts, I drop in two moving averages. Nothing fancy. The smaller one is a 4-period exponential moving average, and the thicker one is a 26-period exponential moving average. What's the logic of 4? By the way, all these concepts, use them on the weekly charts, on a slightly higher time frame. not the daily time frame. So I am over here, the ratio chart on the weekly. So 4 weeks, month, 26 weeks, half of a year. So what I'm interested in is to track the monthly, the rolling monthly price and the rolling half yearly price. Simple. And next, what I'm interested is not only just this absolute price, but the difference between them. In this particular video, we are going to talk about valuation when it is attractive, which means when the markets are in a downtrend, in a bear phase, or it's falling. So we will ignore all these cases when the 4 is above the 26 EMA. We are going to focus only on these areas where 4 is below the 26, right? So it's in a downtrend. Now it needs to revert back to mean. So we are interested when the 4 is stretched away from 26, when the 4 has gone away significant from its 26, when the rolling monthly average price is extended far away from the rolling half yearly price. That's where the panic kicks in. So essentially 4 minus 26. This we can do in various ways. We can create an indicator 4 minus 26. We can plot the awesome oscillator and change the parameters. But what I have done here is I have plotted an MACD. I have plotted an MACD here wherein I've taken 4 EMA and 26 EMA. Rest I'm not interested in the signal line or rest of the things. So I have kind of unchecked these boxes. All that I have got over here in this black line is the difference between 4 minus 26. Now, in simple terms, when this ratio was falling, Nifty is falling more than the gold or sell Nifty, buy gold kind of a zone. This difference between 4 and 26, this difference is getting stretched, which is signified by this fall. Now, how do we know that this fall is an extreme fall? This is also a fall, 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 and so is this. How do we figure out that this falling value of MACD relatively is at an extreme? Again, relativity comes into play. So we can do again various things. But in this case, what I've done is I've just brought in a Keltner channel, and I'll show you the parameters, wherein I have gotten a length of 21 period Keltner channel with 1.5 multiplier. I am plotting it on the MACD, not the price. Okay, so now what do we have? We have a situation wherein we have a banded indicator, Keltner channel, and whenever this value starts to shoot outside the lower band, that's when we start to get interested in that ratio. So in this case, it is Nifty. So the moment this black line, the spread between 4 and 26 starts to drop below 1.5 Keltner channel on the downside, it starts to tell me that it is getting stretched. Now those who are really courageous and would like to buy a falling knife sword, you can start to buy as and when these bars close. But then I would strongly suggest and request, wait for final confirmation from the price. The price should make at least a low, bounce back and create a higher low, and then you should go for buys. Means confirmation should always come from price. You should not buy based on the fact that one indicator's value has fallen below its Keltner channel lower bottom. Use 1.5 for index Nifty. Use 2 multiplier for Keltner for stocks. Okay, so we have the ratio chart between Nifty and gold. We have plotted, or we are interested to figure out the rolling monthly and half yearly values, the spread of that, and an extension, how stretched it is. As we are talking about valuation, we will not be discussing when it is stretched over here on the upside. We're only interested in these cases, when it's falling. So when it's falling, it is also important to understand that it should be in a strong downtrend, which means that I will only look into those situations where 4 is less than 26 EMA. That is, in this case, my moving averages are both red and the 4 is below the 26. With that understanding, let's go back a bit in past as much as we can. This is the weekly chart. So this is, let's say, the top of 2007 onwards. And let's quickly mark from the current situation wherever this particular value has fallen below its 1.5 Keltner channel value. You have to remember that at that point, the two moving averages should be down and 4 should be below. So this is one more, but it is not a very good downtrend. It has just crossed over. I'll still mark it nevertheless. This one, yes, definitely yes. Where all did we find this number going below? I'm not going to mark this. I'll mark it and I'll tell you why I'm not going to mark this, because this one, you see that it is not a very good downtrend because it's still in a nice uptrend. You see the the 26 EMA is beautifully angling up. We want this kind of a completely broken, beaten down situation. Can we use these kind of concepts? Yes, you can, but that's not the topic of this video. So I'm going to ignore this one and let's stick to one more and this one. So as you can see from the past 1, 2, 3, 4, 5, 6 instances, every time we had this line falling below its 1.5 Keltner channel lower border, it gave us a signal, a possibility of a bounce back. Or no, should I say, it tells us that the monthly rolling price has stretched itself away from the half-yearly rolling price. Prices have fallen too much too soon. Maybe you might get a bounce back. You might get a reversion to mean kind of a move. So valuations are attractive. Okay, if you understand fundamentals, if you follow and practice that, of course you can cross-check and figure out yourself whether the ratios are favorable or not. But sticking to pure price, this is one approach. So whenever this line falls below the lower Keltner channel, if I'm doing a spread trade, I would buy Nifty. I would look to buy Nifty and sell gold. Okay. So once we find this kind of a situation where the Nifty seems to be attractive, the valuation of Nifty seems to be attractive. Now the question comes, if I do not trade in Nifty, and as Shupriya's question was, how do we find stocks whose valuations are attractive? How do we replicate this concept in a particular stock? I closely track the active stocks or the most important high weighted stocks which makes up the Nifty 50. These are the 15 names. So let's take up the most famous blue chip of all time that I can think of, Reliance Industries. Okay, so what can we do here? Let's first open a new chart layout. Okay, let's open the chart of Reliance. This is Reliance Industries. I would make some basic changes here. It should be the weekly chart. Now, it doesn't make sense to create a ratio chart of Reliance with gold. Doesn't make sense. What we can do is we can make a ratio of Reliance with Nifty and Reliance with its peers. So we can take Reliance vis-a-vis the CNX Energy or the Oil and Gas Index. So let's do that. So Reliance divided by Nifty multiplied by 100, and now we get the ratio chart of Reliance vis-a-vis Nifty. I can quickly come to this section and I have the template named as value finder. So I can just click on this and all the same concepts, the concepts of the 4, 26, etc., they all come in here. The black line is Nifty. I'm going to remove this. So this we have Reliance vis-a-vis Nifty, and when you use a stock, I would request you use a little bit more because stocks have a little bit of more volatility, range expansion, contraction than the index. So use a 2 Keltner channel. It will just give you a little bit of more scope. So how can I make sense? Very simple. Whenever this particular chart, the MACD of this particular chart that is down here starts to go below its Keltner channel, that is where the valuation of Reliance is relatively better than that of Nifty. So buy Reliance, sell Nifty. That's a pair trade if you do a pair trade. Now, as I was telling you, do not blindly buy because the line has fallen below the Keltner channel lower border. You should always use something else, maybe an MACD crossover, maybe some kind of a pattern, maybe a breakout, a higher, whichever suits you. But take the call based on price and start to observe the chart based on this signal. Use this as a signal. Use this as an opportunity, not a trade. The confirmation from the price will give you the trade. So at this juncture, today, I'm making this on the afternoon of 16th of May, we did see that Nifty had recently given us a nice trigger point, but Reliance is already outdoing the Nifty based on this chart on a weekly time frame, slightly intermediate long-term time frame. The performance of Reliance is better off than Nifty. So we should not look to enter Nifty RIL at this stage. We can click on this. If I click on SBI, it will, I think, change to State Bank of India, and we have to keep on dropping the comparative chart. But if we go back, if we undo this, we find Reliance vis-a-vis Nifty. Now let's take a look at Reliance divided by CNX oil and gas or energy. Okay, let's make it NSE. Now CNX Reliance divided by CNX. Yes, now we should get, yeah, there you go, energy. Okay, I made a mistake. I'll do it once more. Reliance divided by CNX energy multiplied by 100. It will normalize the chart. There you go. Now, by this chart, it's giving us a different story. So Reliance is doing better than the Nifty in an intermediate to long-term time frame, but Reliance is not doing that good in terms of its peers, whichever are the constituents of the CNX energy space. So using this concept, whenever you see that particular stock vis-a-vis the benchmark Nifty, and if you're doing for, like, say something like SBI, you can do it with SBI vis-a-vis Nifty, SBI vis-a-vis Bank Nifty, and look for this instance. Can you use this for shorting when this value is above? Yes, but as I said, this is not the objective of this particular video. This particular video's objective is to find out whether the market, after getting sold off heavily, is attractive or not. And as you had seen some time back, I had a black line, which is this one. This is the Nifty chart. This is a Nifty chart, and if you bring yourself to these, I think, markers, this was the recent fall, after which we got some bit of a bounce back. This was the fall. This is, okay, let me mark, after we got the signal, did we get a bounce back or not? So this is a very good example, because after we got the signal, the Nifty index was in a range for quite some time, and then it gave a move. So as I always, as I just said some time back, please take confirmation from the price. So the recent instance over here was the recent fall when the Nifty was down at this levels close to 16,260. The last bounce back, this was what we could have participated, but it was a shallow one, and it was not a shallow one, but it disappointed heavily. This bounce back was in the tune of around 9 to 10%, so it's not a shallow bounce back. But right now, it's very difficult to say or predict whether the index is actually attractive or not. It's somewhere right there in the middle. I would like to finish this video with a very classic example of the 2009 bottoming out. Please take a look at 2009 bottoming out, so that you get a clear understanding of what actually happens. Let me hide the Nifty first. 2008's first crash got us in this zone, which was this fall. And you did get a bounce back. This would have been a 9-10 kind of a bounce back, percent bounce back. The 4 was below the 26, so we should have looked to participate. It was a healthy bounce back in a bear market. There is no doubt about it. But take a look when the index actually finally bottomed out. This is where it finally bottomed out. And what do you see? That after hitting outside the Keltner channel, it actually stayed within. It came down, came close, but stayed within. It did not go outside the Keltner channel. What does this mean? This implies that when there is selling in the market, which is sharp, one-way, panic-driven, this line is very likely to shoot outside. So you'll be essentially participating in those sharp bounce backs. Number one, remember that. Number two, when the market starts to or shows signs of bottoming out slowly, then there is no panic, because jo panic yahan pe hona tha, I remember this very well, most of it happened at the beginning and the rest of it happened here during October. Towards 2009, Jan, Feb and March, there was not much of panic. Jo damage hona tha already ho chuka. And so the market took its own sweet time. So over here what you can use is something called price MACD divergence. Remember what is this black line? The black line is MACD. So as price keeps on falling, if we see MACD is rising, this is nothing but an MACD divergence. So this approach will help you not only to identify a beaten down stock or index which has fallen sharp all of a sudden, but it will also help you to identify divergences when it's trying to bottom out or top out in a slow and steady manner. So let's finish this video. Coming to the current situation, it's difficult to say. The trend is down, so we might expect further downside. Recently, it had shot outside with this panic sell-off. Now it's more of a consolidation for the market. It's not in a correct situation to tell us whether it's bullish or bearish. In the short term, it's trying to bounce back. We'll see how these trends and prices unfold. But I hope I made some sense to Shupriyo's question. How can we find value picks? His question probably needed me to answer with stock names, but I'm sorry, I just went ahead and shared one of my concepts, approaches in which I try to find those stock names. I hope you found this useful. If you liked it, do subscribe. Let me know about your thoughts. And as I always say, take care of yourselves, trade well and trade wise.